cryptocurrency composition, tokenomics, supply, and governance. Welcome, everyone, to today's deep dive into the world of cryptocurrency tokenomics. Have you ever wondered what underpins the value of a crypto asset? In this video, we're going to explore the economic blueprints behind cryptocurrencies and break down everything from token creation to supply dynamics and governance structures. Let's start with the core concept, tokenomics. Simply put, tokenomics is the study of how cryptocurrency tokens work within an ecosystem. Think of it as the intersection of economics, technology, and community dynamics. A robust tokenomics model can provide incentives for network participation, create value, and drive the evolution of a project. At its heart, tokenomics includes aspects like how tokens are created, how they are distributed, and what roles they play within their respective ecosystems. If you look at a platform like Binance Smart Chain on which many tokens operate, you see that each coin's design encourages holding, staking, and usage within a broader DeFi ecosystem, a real-life parallel to ecosystems in nature where every species plays a role. One of the first questions we need to answer is, how are tokens created? In the world of cryptocurrencies, there are two primary approaches. Mining. Mining is the process by which new coins like Bitcoin are generated. It involves solving complex mathematical puzzles using computer power, and in doing so, miners secure the network and validate transactions. Bitcoin's mining process was transformatory because it created a decentralized way of issuing money without any central authority. It also established the concept of scarcity. Bitcoin's fixed supply of 21 million coins ensures that no more than this amount will ever circulate, giving it properties many compare to precious metals like gold. For instance, many mining farms in regions with abundant renewable energy such as those in Iceland demonstrate how real-world factors like energy costs and climate shape the mining ecosystem, making Bitcoin mining both a technological and geographical enterprise. Pre-mined tokens. On the other hand, there are pre-mined tokens. These tokens are created all at once before the cryptocurrency even reaches the market. This approach is popular among many modern projects that want tighter control over token distribution and wish to raise funds quickly through initial coin offerings, ICOs, or other fundraising mechanisms. With pre-mined tokens, the entire token supply exists from day one, but it doesn't all enter circulation immediately. Instead, developers, early investors, and community members receive tokens gradually or based on specific milestones. Ripple's XRP was pre-mined. All XRP tokens exist from the start. However, they are released gradually through controlled sales and partnerships. This method allows Ripple to work strategically with financial institutions while carefully managing market dynamics. Circulating supply vs. total supply. Now, let's discuss the difference between circulating supply and total supply. These terms might sound interchangeable at first, but they represent very different things. The circulating supply is the number of tokens that are currently available to the public and actively traded on the market. It's the figure you usually see quoted on market cap sites, and it gives you a sense of the liquidity and availability of a cryptocurrency. In contrast, the total supply includes all tokens that exist whether they are available for trade or locked up and reserved by the project's founders, developers, or through vesting schedules. Consider a hypothetical project that announces a total supply of 1 billion tokens, but only 100 million are currently circulating. This discrepancy might be similar to what happens in projects like Chainlink or Tezos, where vesting contracts for locked funds mean that a large number of tokens remain out of immediate circulation. Investors should be aware that if these locked tokens are released suddenly, it could lead to notable price volatility. Bitcoin is perhaps the textbook example. Its limited supply of 21 million coins contributes to its value proposition, a scarce resource in a financial system where central banks can print fiat money endlessly. As of now, around 19 million coins are in circulation, highlighting the scarcity factor that many investors find appealing. Governance models, deciding the future. But supply isn't the only factor to consider. Equally important is the governance model behind a crypto project. Governance determines how decisions are made within a network, whether by decentralized system, consensus algorithms, or small group of core developers. The more decentralized the governance, the more resilient the project might be in the face of external pressures. Decisions such as protocol upgrades, fee structures, and future token issuance are all influenced by how a project governs itself. Bitcoin's conservative governance. Take Bitcoin, for example. Its governance model is relatively simple, rooted in mining consensus and long-standing community discussions. Changes to its protocol require widespread agreement among miners, nodes, and developers. This conservative approach has maintained Bitcoin's stability over the years. For instance, consider how any proposal to change Bitcoin's block size undergoes rigorous debate on forums and developer meetups. The eventual split that led to Bitcoin Cash in 2017 underscores the challenges and strengths of Bitcoin's decentralized consensus process. Ethereum's adaptive approach contrasts Bitcoin with Ethereum, which has adopted a more flexible governance model. Ethereum allows its community to propose changes and conduct network upgrades through both on-chain signals and off-chain discussions. Notably, Ethereum uses a mix of inflation to incentivize validators and token burning to counterbalance inflation, thereby adjusting its supply dynamics over time. The decision to implement the DAO hard fork after a significant hack in 2016 demonstrated Ethereum's ability to adapt. The community voted to reverse the losses incurred, setting a precedent in the blockchain space for how adaptive governance can steer a project through crisis, albeit not without controversy. Beyond Bitcoin and Ethereum, we see a wide spectrum of governance approaches. Some projects opt for highly centralized decision-making, where a core team holds significant power over the network. This model can streamline updates and allow rapid responses in turbulent markets, yet it may raise concerns about transparency and central control. For instance, early in its journey, Ripple's governance was criticized for its centralized control, as a significant portion of XRP remains under the stewardship of Ripple Labs. This centralization can lead to faster decision-making but also risks potential market manipulation. On the other end, fully decentralized autonomous organizations DAOs rely on token holders to vote on every major decision. In such models, each token may represent one vote, ensuring that decisions reflect the community's collective will. MakerDAO is a prime example, where MKR token holders regularly vote on proposals affecting everything from collateral types to stability fees. While this bottom-up approach embodies decentralization, it sometimes results in slow decision-making due to the need for broad consensus. No governance model is perfect, and what works best often depends on the project's goals and the community behind it. E.g., Tezos uses an on-chain governance mechanism that allows token holders to vote on upgrades directly, demonstrating both the potential and the challenges of trying to implement a system in a rapidly evolving technological landscape. The interplay, tokenomics, supply, and governance. The interplay of token creation methods, supply metrics, and governance structures is what gives each cryptocurrency its unique character and potential for value creation. Investors, developers, and users must understand these factors to make informed decisions about which projects to support and invest in. For instance, Cardano's rigorous academic approach to tokenomics illustrates this interplay perfectly. With a fixed supply and a predictable inflation rate combined with a well-designed, largely decentralized governance structure, Cardano stands as a model for long-term sustainability and innovation. Whether you're looking at the fixed scarcity of Bitcoin, the dynamic supply adjustments of Ethereum, or emerging projects with innovative governance mechanisms, the fundamentals of tokenomics remain a critical lens through which to view the crypto landscape. As we wrap up, remember that the cryptocurrency market is still in its infancy. The various models and mechanisms we've discussed continue to evolve as projects innovate and market demands shift. Staying informed about the latest developments in tokenomics, supply management, and governance is essential for anyone who wants to navigate the space successfully. It's not just about understanding the numbers, it's about understanding the philosophy behind the design choices that make each project unique. The recent upgrades in Ethereum 2.0 and the evolving model seen in decentralized finance projects like Compound or OV underscore how innovation in tokenomics and governance can not only stabilize but also enhance investor confidence and network utility. We've unraveled the basics of tokenomics from how coins are created by mining and pre-mining to the critical distinctions between circulating and total supply, and finally the spectrum of governance models from conservative consensus to adaptive, community-driven upgrades. To put it another way, imagine Bitcoin as scarce digital gold, while Ethereum represents a programmable platform that continually reinvents itself, and newer projects learn from both these examples as they strive for innovation in areas like decentralized governance and supply management. Your understanding of tokenomics, supply, and governance will not only enrich your knowledge but also empower you to make smarter decisions in this rapidly evolving space.